And then we come back to CEO report
Yes,
after.
okay.
Yeah. Okay, perfect.
One comment in announcing the agenda change, Herman, it'd be a good idea just to say that it's without objection, because if technically, if there are objections, there would need to be a motion. That's not going to happen here. But just to ensure we've got our I's dotted and T's crossed.
You got it. Thank you very much for that. I believe it's 9 o'clock on the
Yep.
dot. And I'm calling the Board of Investment meeting to order today being Wednesday, June 8th, and it is 9 a.m. Linda?
Thank you, Chair Santos. This meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Knox is absent. Mr. Green?
Here.
Mr. Kehoe?
Present.
Thank you. Ms. Greenwood? Okay. Mr. Jones?
Present.
Mrs. Jones?
Present.
Okay. Mr. Kelly is absent. Ms. Sanchez? Okay, and Chair Santos.
Here.
Okay, staff participating in the meeting include the following: CIO John Grable, CEO Santos Cramen, Chief Counsel Stephen Rice, DCEO Louis Lugo, AEOs JJ Popovich and Laura Guglielmo, Barry Liu, Ted Granger, Christine Rosalind, and investment staff include Jude Perez, Pushpam Jain, Derek Kong, and Shara Liu, and the consultants are Makita Investment Group, Alborn, Stepstone, and Milliman. Trustees, please use the Zoom chat option to be placed into queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak, and now we may proceed with the agenda.
Thank you, Linda. Colleagues, due to some of our colleagues' inability to stay through the meeting today, we're going to move the action items first in order to make sure that we have the quorum so we can vote on those items. Is there an objection for me to change the order of the agenda? Hearing none, and without objection, we're moving forward. Approval of the minutes for the meeting of May 13th, 2022.
This is David, so moved.
It's been moved. I need a second.
Second.
It's been moved and second. Any changes, amendments?
No.
Hearing none, roll call, please.
Mr. Green?
Aye.
Mr. Kehoe?
Aye.
Okay, Mr. Jones?
Aye.
Mrs. Jones?
Aye.
And Chair Santos.
Aye.
Thank you. The motion passes unanimously.
Thank you. Consistent with our prior discussion and agreement, moving to section 7, consent items. I will entertain a motion for approval.
I'll make the motion.
Second.
It's been moved and second. Any questions, comments? Hearing none, roll call, please.
Okay, Mr. Green?
Aye.
Mr. Kehoe?
Aye.
Okay, Mr. Jones?
Aye.
Mrs. Jones?
Aye.
And Chair Santos.
Yes.
Okay, the motion passes unanimously.
Thank you for that. Moving forward to section 8, not consent items. Recommendation by Mr. Liu, Barry Liu.
Yes, good morning, Chair Santos and Board Trustees. So this is an item to adopt the revised legislative policy. Just to kind of go over some highlights, the main change we made harmonize this policy with the corporate governance and stewardship principles. I worked with Mr. Drazo on this to just kind of make sure that the principles deal with certain matters and that the legislative policy deal with other matters, and that to the extent that the principles don't cover certain matters, the legislative policy would sort of serve as a default. And then in addition to that, there were other items to update just to reflect our traditional advocacy on the repeal of the windfall elimination provision and the government pension offset, and also with the repeal of the direct payment requirement for public safety officers for their tax exclusion in order for them to use their retirement distributions to pay for healthcare benefits. And then finally, the evaluation are legislative advocates. I currently do that evaluation annually, but this would make it so that the advocates can also do a self-evaluation as well. So those are mainly the four main changes in the policy, and I'm happy to take any questions.
Great, thank you for that. A quick comment, it was about time that we reconciled the Board of Investment policy and the Board of Retirement policy. This is great. Outstanding work. I will move the item, move approval.
David, I'll second
I'll
it.
second.
Okay, it's been moved in second. I don't see any requests for comment or questions. Roll call, please.
Mr. Green,
Aye.
Mr. Kehoe,
Aye.
Mr. Jones,
Aye.
Mrs. Jones,
Aye.
and Chair Santos.
Yes.
Okay, the motion passes unanimously.
Okay, so at this point, we're going to move into executive session.
Yes, and I have to just move some staff members into the waiting room, so I just need like 1 minute and I'll make sure everybody's moved there.
Yes, ma'am.
Okay.
Let me know when you're ready, Linda.
Just 1 second. We're just trying to go to live right now. Just 1 second. Okay, we're good to go.
Good to go. All right,
Yep.
thank you, Linda, for that. Going back to the original agenda, the CEO report.
Yes.
Mr. Craig.
Yes, Chair Santos, trustees, good morning. Just wanted a very brief CEO report update for you all. Just wanted to let everyone know that our strategic planning process is moving along. We've had a couple of meetings now with the Spark team, which consists of the trustees as well as the executive management team and other senior managers of the organization. We are planning on sending out a survey to our members. I believe that will be going out sometime in June to get a feel for our members, to get our members' feelings about how we're doing in terms of providing services that they're asking for. I did want to let everyone know also that the safety member election, the filing period for the nomination papers is fast approaching. June 17th is the final day to submit the nomination papers. I haven't heard that anyone's filed just yet. So I want to make sure that I let you know that. We're continuing working on our hybrid work model. We have about 25 to 30% of our staff on site on any given day. I believe that it's been working fairly well. We are continuing to monitor or making some modifications to certain requests that some of our managers are having in terms of providing a hybrid work model for their particular units. Also, in terms of recruitment, I know that we've been working with Mr. Grable, trying to get resumes and applications in. We've completed our brochures. Those should be going out for a number of positions. We're actively recruiting candidates to submit their resumes so that we can move quickly on trying to go through the process of recruiting and then hiring them on board. Yesterday, we posted the attorney position, staff counsel position for investments. So that is out on the street as well. And so we'll be soliciting and recruiting for candidates to assist in that area that Mr. Rice has identified as a critical position to fill. So that's really, I did one last thing is the retiree healthcare. We do have a meeting with the county CEO and their consultants regarding the $1 million cap. And so that is going to be on Friday. I believe it's supposed to be a consultant to consultant meeting so that they can talk about some of the assumptions that are embedded in their analysis that we received about a month ago. So with that, I'm more than happy to stand for questions.
Mr. Jones.
Good morning, Santos. Just a quick question for you regarding the vacancies, knowing that it's the kind of round robin of vacancies has been pretty meaningful since I've been on here a little over a year ago. Just a quick question, in terms of sourcing, is the primary fertile ground, are we basically trying to recruit away from other public pension funds? Is there a certain set or, medium-sized public finance firms that we tend to have success for? Where do we tend to find, the human capital to fill the gaps that we are? And if we don't know, is there any kind of analysis being done by an outside recruiting firm or otherwise to say, here's where we're most likely to find kind of the fit and performance people we're looking for? Thanks.
I don't know the answer to that question off the top of my head, but I know that Carly and Laura have been working with John as well. And John could probably add a lot to that. And then Carly can also chime in terms of what we're trying to do to advertise our open positions. So I would encourage John to make a comment, and then Carly can follow up.
Sure. Good morning, Mr. Jones. There are a variety of recruiting channels and organizations. I don't think that there is a dominant, maybe the plurality, maybe from within Lacera, that there have been, a fair number of promotions from within the investment division, as well as I believe we have people from both FASD as well as the legal office in the investment division. We have tried to broaden the recruiting channels through a variety of industry associations, be it organizations such as CFALA or job boards that certain organizations that we affiliate with, such as Twigo, that they post, that just to broaden our recruiting network. But there's just a variety of backgrounds. And as the asset allocation has gotten more complex and our implementation more sophisticated, I would say that the unique skills and the different types of skills that comprise the investment division have evolved.
Quick question. Do we also, in addition, before Carly comes on, I'm sure she's going to comment, do we have like any referral bonuses? Are we kind of leveraging the peer professional networks of staff, with bonuses at all if they refer someone who ultimately fills and accepts a position?
I don't know the answer to that.
We do not have a referral bonus program. We would have to research whether or not that's actually even acceptable under the civil service standards and so on and so forth. I know that we do use recruiters that do receive compensation as a result of a successful placement, but not referral based. But Carly, did you want to expand?
Yeah, absolutely. Good morning. I think that Mr. Grable's assessment of how we recruit is accurate. So we do not specifically poach. We do not specifically target large firm, medium firms and seek to entice their employees over. We do use a variety, as Mr. Grable said, channels. I might say platforms or specific organizations by which to recruit. We have a list of about 20 that are in constant, we use specifically in all of our recruitments. There's about a list of 20. And then if we need to dig deeper and find, for example, specific organizations, I don't know, that might be specific to the asset category, we can also use those.
Okay. I just know it's been again, I've only been here a little over a year or so, but I know it's been kind of a persistent, even within the investment division, but overall, 14 to 20% vacancy rate for positions. And I know that's perceived as a risk to our overall performance. And so just trying to, get a little clarification whether we were doing some things to perhaps switch up the efficacy of either the channels or sourcing partners or what have you in that regard.
Yeah, I think that's a very good point. And what we're also doing is we're looking at our own internal processes to see how we can, make them more efficient. Right now, a lot of the procedures and the processes that we go through for recruitment are sequential. And there are certain areas that I think that we can make things a little bit more efficient, collaborating, for example, as opposed to waiting for an email. We're trying to use more of the collaborative tools and teams so that we can look at documents together at the same time and make edits and so on and so forth. And so I know that Carly is working on that, and Laura is also working on that. And so we know that it is a critical issue for us. We do have a hiring plan in place. It's going to take us a little while to execute on that plan. But we are making progress. I don't want you to think that we're not. We've hired a few attorneys, for example. We have the member services folks that have been hired. Now we're concentrating on our investment side and trying to do everything that we can. We do sometimes stumble a little bit, but we recover and then we move forward. And so we're in the process of doing the best that we can to get Mr. Grable and Mr. Rice and the other divisions what they need in terms of employees. We're also looking at trying to leverage some of the compensation studies that have been completed at CalPERS. We're reviewing those particular reports, and then we're looking to launch our own compensation study ourselves once we have a better handle on our recruitment process. And so we have a lot of irons in the fire. And so we're just going to have to be a little bit patient on us, getting that vacancy rate down. It's going to take us, 12 months to maybe a year and a half to try to get that down to the single digits that we're looking to do.
All right. Thank you. Thank you for the floor, Chairman Santos.
Mr. Kehoe.
Thank you. Two comments. One, I think Mr. Jones' comments were great in regards to the recruitment bonus. I do know that you can do that with civil service because many police departments are having recruiting problems, and they give bonuses to officers that recruit. So that might be something to look onto to leverage our own in-house staff and have them get some bonuses on that. And then there's also a possibility of sign-on bonuses, so maybe we should look into that. And you can structure that so that people don't just take the money and run. You can say, you're going to get $50,000 over a 5-year period or whatever the case is. 10,000 bonus a year for the first 5 years. That way they sign on and they stay for a bit. So those are two things. In regards to the safety election, just to close any rumors or anything like that, I did pull papers, so I do have papers to pull. So just didn't want any rumors floating around on that one. So that's it.
Sorry about that.
Thank you, Mr. Kehoe. And just to expand into what has been said, and particularly with compensation, the Board of Retirement last week instructed the CEO to meet with both boards for the purposes of extending the SEIU negotiated agreement, collective bargaining agreement between the union and the county employees. I think it's critical that we do that because we need to keep our people, meaning the staff, in a part with LA County, given the great resignation that we have, that we're going through, and the vacancy rate. I mean, that Front Fire article yesterday, or whatever was it that we received, it was a rude awakening, because this is something that we've been talking about for now a year. And with regards to the salary compensation, I've been saying that in the Board of Investments and at this board for probably a year now. So the fact that we haven't pursued that is concerning to me, because now here we are, with all those high vacancies, and as Mr. Jones pointed out, it's a high risk. So I know you're doing everything you can, Mr. Kryman, but we need to just continue our diligence to reduce that risk and the vacancy risk. Thank you for that. Anybody else? Okay, hearing none. Next, moving forward, next item is this CIO report.
Good morning, Mr. Chair, trustees. Want to thank Scott for driving slides this morning. I'm impressed that Scott did something I know I couldn't do. I once tried to speak and drive slides, and it didn't, work out so well. It's hard to believe that this is the last scheduled meeting of the fiscal year. We have 22 calendar days left in the fiscal year. Our fiscal year returns and numbers do not appear to be what they were a year ago. With that said, I believe that our initiatives this year have had a greater impact on our performance. Last year the good times took care of themselves. In flattish markets is where we really have to earn our keep. If we can turn, Scott, to slide 4. Thank you, Scott. I'll start on the chart on the upper left. This is results of the global equity markets for the month of May. May had much intra-month volatility that was masked by the flattish net performance during the month. What this whole page shows is that over the past year, global equities and investment grade fixed income are both down. And when the two big drivers of global capital markets are down, there's a little place to hide. And I know that this is something that I say too often and will continue, I promise to say it too often, is that that's the benefit of diversification. If we can turn to slide 6, please, Scott. The chart on the upper right focused on a bit over the last couple of years. In it, we can see higher inflation. You can't turn on the news. You can't drive down the street or walk down the street without seeing the impact of higher inflation. The chart also combines on it that workforce participation is down from where it was pre-pandemic, yet unemployment rate is back to the pre-pandemic levels. So these are really powerful macro factors, and we have our offsite planned for September. One of the sessions that trustees voted on is a macroeconomic session, and the impact of factors such as these will be discussed at the offsite, because it's really important. And we discussed this last month, that there may be a new investing paradigm driven by factors such as this, and many managers may have never invested through it, which means we have to remain ever vigilant, which we are. Slide 9, please. So the fund was down, as we can see on this slide, 3% net in April. Certainly a down 3% month is not a good month, but that's not beyond expectations. Something that the board put in place several years ago was a comprehensive risk system, version 2 of a risk system for us. And one of the measures that we use in that system is called value at risk, or VAR. And VAR, while it's not depicted on the slide, measures the risk of a loss for a set of investments, assuming a normal distribution over a period of time. And going back to that down 3% month, that is not an outlier according to our value at risk, or VAR, scenario testing, that in fact, we should expect a down 3% month, maybe several times a year. So going back to what I say too frequently is that our VAR, or that amount that's at risk, is reduced by having a diversified portfolio. Because if you were to look at an all public equity portfolio, its VAR would be much higher, and the probability of a down 3% month for that all equity portfolio is much greater. So, and Scott, if we could turn to slide 11, and then we're going to come back to slide 9. Slide 11 says this a little differently, which is the benefit of diversification, that we can see in the column here, the column that says contribution to total fund risk, that our growth category, which is predominantly equity, is 50.8% of our assets. And you can see that under growth in the row near the top, yet it accounts for 82.6% of our forecast volatility. So the weighting for the volatility of the growth category, which we need to pay long-term benefits, is greater than the asset category weighting. And that differs from our 3 other major asset categories of credit, real assets, and risk mitigation. All of them have contributions to risk less than their asset weighting. So that is a way, an easy pictorial way, sorry if it's a little bit wonky, of looking at the benefit of diversification. And Scott, if we can go back to slide 9. Thank you. We can see on this slide, the total fund was at 72.8 billion as of the end of April. Our asset allocation is on the right and it's on target. And one thing I'll note is as of the beginning of next month, we go the full way to our new asset allocation. So these numbers will begin to change. We can see as we turn to the next slide that April was a tough month for all our functional categories in the pension. What this slide also shows is that the fund was down 3% for the month of April, and OPEB was down 5.2%. And OPEB has a balance of about $2.5 billion. And in down markets, the focus on fees tends to increase, and that's natural, as every basis point counts. So I'll make several observations that are really embedded in the numbers that are on this slide. And I'll start with that fees are based on either our assets under management in a mandate and or the performance of that mandate. So against those 2 measures, we strive to have the best terms. However, we want the most assets and the best performance within every given mandate. So there potentially is some dissonance or distaste that there are cases in which we're better off with higher fees, but that's if and only if we have the best terms. Second observation is that the lowest cost portfolio may not be the best portfolio in any given environment. And here I'll compare the performance of the pension and the OPEB trust. The OPEB trust has blended fees of about 10 basis points all in, compared to the pension, which is a much higher cost plan, which has blended fees of, call it about 50 basis points or 0.5%. If you look on this chart over the last 5 years, the pensions had better performance than OPEB. And if you focus in particular in the last year, the pension has outperformed OPEB by 8.3% or 830 basis points. Now, that's not always going to be the case, but the pension outperformed with higher fees, and that performance was net. But the pension also has lower volatility, and it's something that we're very focused on, that the pension is cash flow negative and the sequence of returns matters. And that's something that we'll discuss later this morning during the actuarial discussion. The other thing, a couple other things I'll highlight. One is that it relates to our allocator to best-in-class investor strategic plan, that we've had tremendous fee-saving initiatives, which are one of the pillars of that plan. I'll give a couple of examples. Private equity co-investment. Since we brought that in-house in July of 19, based on the recent performance of that plan, we've saved probably about $15 million. Public equity, we've reduced the cost of that program from 18 basis points in 2018 to about 11 basis points today. That's a 40% reduction in fees. I don't cite a dollar savings because we have a lower allocation to global equity today than we did in 2018. Illiquid credit, we've removed a fund of funds level of fees. We use dedicated managed accounts. We've negotiated hard fee hurdles. Going back to that, we strive to have the best terms. And based on the performance of that program, we've probably saved on an annual basis about $50 million. 50, that's a lot. Hedge funds, we've also removed a level of fund of funds fees. We've negotiated and allocated money to lower fee share classes. We have in our emerging manager program some revenue share relationships. And based on the performance of that program, because some of that is performance-based fees, we've probably saved about $15 million on an annual basis. So these are tremendous savings consistent with doing right by our members in terms of having higher share of performance, but consistent with our strategic plan of having a focus on fees and cost of capital. And the final observation is risk-adjusted, fee-adjusted performance is our primary focus. We address fees in our investment policy statement, including our investment beliefs. That's also something that we'll revisit at the offsite. A fee analysis is part of our asset allocation and structure reviews. And once again, it's consistent with our strategic initiatives. Slide 15, please. Thank you. This fiscal year is a seesaw, unfortunately, in terms of changes in our net fiduciary net position. We've been alternating between up and down months. Something I did mention last month is our actions during the strategic asset allocation exercise of reducing our global equity exposure during what was then a bull market, better position us for these non-uniform markets. And I believe that that's paying dividends for us. Also, and based upon some of the discussion that we have had this morning, is that having an agile investment team assist the Board of Investments in implementing this diversified portfolio enables Ocera to meet its mission to our members. Slide 17. Building on that, in that prior slide that we discussed showed in fiscal year 21, there was a $13.8 billion increase in fiduciary net position. Fiscal year 22 to date, we're down about $190,000. Now I'll put that in context of the bottom left of this page, hedges and overlays, that there is a tremendous benefit from our collective focus on total fund management. If we look at the cash overlay and our currency hedge, in the month of April, those two programs generated over $65 million. So that's really material against a drawdown in the month of April, down 3%. So that $65 million is an incremental 9 basis points. I mentioned earlier that basis points matter, but our actions really are paying dividends for our members. And if we can turn to slide 21, pardon me, Scott. This is just a reminder that we include each month charts of the month submitted by different people on the investment team. These are things that the team finds interesting. There are 2 charts this month and a couple of thoughts on the 2 charts. First, this one shows that equity market volatility is significantly higher than it has in past years. And that's consistent with the commentary that we've had and what we've discussed this morning. One of the things that I find interesting about this slide about the equity markets is that it was submitted by the risk mitigation team, our bond team, our hedge fund team. And I think that shows the total fund mindset that members of the investment division think beyond their primary of focus. And that is how the portfolio better performs when you understand not just what you're doing, but you understand it in context that really enables all of us to make better decisions. The second slide, slide 22, I believe it is, shows that the Fed balance sheet has grown significantly. The size of that balance sheet, is likely distorting markets and may be a further headwind to performance, but it's something that we are mindful of and may in fact impact things such as inflation, things that we will discuss at the offsite. And with that, Mr. Chair, I'll pause for questions.
Chairman Santos, I got a quick question, please.
Mr. Jones.
John, a quick question regarding the balance sheet. I appreciate the staff chart this month with the QT program going on now. I'm kind of surprised not to see a little bit more of a downward trend. Maybe we're still early in that process. From a headwind perspective, I mean, do you look at QT in and apart from the inflation numbers and all that stuff, just the fact that those programs are going away as an opportunity or as just a risk to be managed as liquidity is pulled out of the system overall?
I think yes and yes. I think that there's some asset categories where it may present opportunities, others where it may be more of a headwind. At some point in time, I think that there's a benefit to getting a higher return from our core fixed income portfolio. That certainly, rather than asking 80% of the assets to earn 10% to get, that 7% number, there's greater contribution across asset categories. But I think that there are aspects of the portfolio that will do well. There are others that may have a harder time. Private equity firms may have a harder time financing transactions, may have to put greater equity in those transactions that may drive down returns on the margin. But I think that we can sketch out in an interesting discussion the impact on different asset categories. And I think that's really one of the benefits of when we do structure reviews, just to really look at how an asset category can perform against certain macro factors, such as a rising rate environment that may be precipitated by rising interest rates, and as you highlight, that quantitative tightening.
Thank you.
Thank you for that, Mr. Grable. The only comment that I have is that I really appreciate the discussion about the amount of savings that we generate in both from the fee negotiations that the staff engages in on a regular basis, as well as the fact that we brought some of the operations in-house and we were able, like the secondary market, we've been able to generate a tremendous savings there from fees. I think it would be a good idea if we can put that in writing somewhere. I mean, it's embedded in the numbers, but I think it would be good idea because this is an area that we can really be proud of. Also, really appreciate the fact that the asset allocation that this board work on in the past is paying dividends. This is something. It's a victory lap, so to speak, that is important. That is reflective of the work that has been done over the years, especially on the leadership, Mr. Grable. And also thank you for the reminder that sometimes the most economical portfolio is not the best performance portfolio there. And I think that's something that as long as I've been in this board, there's always been a debate. Yes, we want to minimize the fees, but we cannot, and we have to be really careful that sometimes if the pendulum swings too far to the left or the right, whichever side you want to look at it in terms of the fees, it can potentially impact the returns. And that's a very important discussion that we should always have, that sometimes, my dad used to say, be careful because you might get what you pay for. And that was true throughout my whole life, that whenever I tried to really be adamant about the reduction in fees, I usually end up with the lousy work at the end. So great presentation today. I really appreciate that. This is something to feel proud of. Any other comments, questions, concerns? None. We're moving forward. So at this point, we move to section 9 reports. Mr. Kryman, the actuarial risk report.
Mr. Granger will lead us with that.
Okay, Ted, you got the floor.
Great. Good morning, Chair Santos and Board of Investment Trustees. My name is Ted Granger. I'm with Lacera's Finance and Accounting Services Division. With us today in the meeting is Nick Collier from Milliman and Craig Glide, our consulting actuaries. So if you'll give me just a couple of minutes, I'll provide a quick overview of sort of why we're here and what we're doing. We're here today to present a report prepared by the consulting actuary, the Actuarial Risk Assessment Report, or as we call it, the ASOP 51 report. Although some of this information is typically included in our evaluation reports, staff felt that this information is important enough to develop a separate report and bring this information to the board for some discussion. We hope to accomplish a few objectives today. Basically, this presentation serves as sort of a mid-year check-in point, sort of a chance for us to discuss actuarial concepts. And it kind of potentially becomes an educational opportunity where we can refresh and refocus on actual concepts, again, sort of at a mid-cycle point in time. It allows the board to evaluate these key actual concepts outside of a routine report presentation, taking some of the pressure off of making decisions, at this particular moment. This, again, is an informational item for today. Quick couple things on background. The Actuarial Standards Board, or the ASB, sets standards for appropriate actuarial practices within the United States. These practices are called ASOPs, or Actuarial Standards of Practice. We liken them to accounting standards, essentially. ASOP 51, the title of it is the Assessment and Disclosure of Risk associated with measuring pension obligations and determining pension plan contributions. So I just wanted to kind of provide sort of some context around the standard itself. The report is a risk report. It addresses risks in the following areas, risks surrounding measuring future pension obligations, risks around projecting investment returns, risks surrounding determining future contributions, and finally, of course, risks in assessing impacts to the plan's funded status. Milliman will also identify controls to help mitigate these risks, as well as the pros and cons of these mitigating controls. This report is meant to serve as a tool for trustees to use in future decisions on matters such as asset allocation and setting actuarial assumptions. And that concept in terms of setting actual assumptions leads me into a quick reference to our roadmap. We did include as attachment D to the memo, a roadmap, and I'll just provide a couple of quick highlights. We are embarking on an experience and assumption study for fiscal year end June 30, 22. That's this year, that's this cycle. So we will have an experience and assumption study as part of a 3-part series of meetings with the board beginning in October, November, and December. We'll discuss the economic assumptions first. We'll move into the demographic assumptions. And finally, we will wrap it up with the draft report in December, where all of our decisions will be made. Milliman will apply those assumptions to the next valuation report, and that will be prepared and presented to the board in March of 23. So unless there's any questions for me on the overview, I'm going to hand it over to Nick Collier with Milliman. And thanks, by the way, thanks Scott for driving the slides. We appreciate it.
Thanks, Ted. Good morning. As Ted said, we're here to discuss our risk assessment report, which focuses on the risks to LACERA's future funding levels and contribution rates. Big picture, the story is very similar to what we told you last year. It should be noted that the analysis we are presenting today is based on the most recent actual valuation, which is as of June 30th, 2021. So it reflects the strong investment returns for the prior fiscal year, but does not reflect the market volatility that's happened since then. Moving to the next slide. Thanks. So we spent a lot of time during the triennial experience study trying to get the best possible set of assumptions to predict the future. One thing that's virtually certain, though, is that future is not going to match the assumptions. The risk assessment gives the board some idea of the potential impacts of when this happens. The risk assessment is designed to give the trustees information on risks specific to future pension liability measurements, And this may be helpful in the board's carrying out its fiduciary responsibilities. We also identified and assessed the risks that may be significant to the plan. And just to note that these risks are similar to the ones that we identified in the last study, so no change there. Lastly, we disclosed plan maturity measures and historical information, which may be helpful in giving the board some perspective on the plan's risk. As Ted said, this is guidance on that's provided under our actual standards of practice. So we're not going to look for any actions today based on the risk assessment, but it should provide additional context for our upcoming discussion on the assumptions and methods that Ted talked about as part of the triennial investigation of experience. So a lot has happened in the economy since the last valuation that has and will affect GLSERA. I'm going to turn it over to Craig to try to summarize all of that in about 2 minutes on the next slide.
Okay, next slide. Thank you. So yeah, as we heard this morning already, there's a lot of macro economic challenges and headwinds that are facing GLSERA and sort of the entire world right now. And certainly since we were here last year to talk about the last year's risk assessment report, the macro environment has changed quite markedly. While that doesn't necessarily affect the types of risks that are facing GLSERA, it will have an impact on the potential significance and magnitude of specific risks. So some of the macro environment challenges that we're facing right now are listed on this slide. And while they're certainly not mutually exclusive, so it makes it hard to attribute any one particular factor to a specific risk. Cumulatively, we do know that they are contributing to a higher level of risk in certain areas. And it still remains to be seen how many of these challenges and headwinds are going to be short-term or more long-term in nature. But just to give you a quick rundown on the factors that we've listed here, and the situation surrounding COVID continues to evolve. Fewer people certainly appear to be getting seriously sick and dying, but there's continued disruptions to workforce and supply chains, and people in general seem to have some changing expectations for their life and their work that is continuing to cause disruption for employers and businesses. In addition to that, in addition to the tragic loss of life that we have, the war in Ukraine has caused significant geopolitical unrest, and that's had an impact on energy and food supplies specifically, and on supply chains in general. We've also seen significant investment market volatility so far in 2022, as you've heard. And to date, the S&P is down approximately 12 to 13%, and the bond yields on high quality corporate bonds have increased approximately 150 basis points year to date. So while in the short term, this hurts the market value of GLSERA's portfolio, those higher bond yields in the long term, there may be higher expected returns available in certain fixed income investments than we've seen certainly in recent years. CPI is currently running at about 4-decade highs, and it's about 8% year over year, and it close to 4% year to date in 2022 through April 30th. This is obviously due to a combination of factors, including the global central bank stimulus that we've seen over the last 2 or so years, and the problems in the supply chains caused in large part by the pandemic, and now the war in Ukraine contributing to that. So the increase in the CPI is putting pressure on wages and is likely to result in higher retiree COLAs. And so those are both going to be higher risk factors for GLSERA. There's a general shortage of employees, and employees are leaving the workforce or their current jobs at faster rates than we've seen before. And so that also could be putting pressure on wages going forward, increasing risk on compensation and payroll growth. We know that the Federal Reserve has already signaled their intention to raise interest rates to combat the high inflation, and many economists and strategists are speculating that that potential has a significant potential to head us into a recession And that, of course, is going to, if it does happen, will create a lot more challenges and headwinds going forward. So all of these factors have a direct or indirect impact on the risk and return profile of Lacera's portfolio and their membership. And as we move on to the next slide, we'll try and put those in some ranking. So on this slide, we are showing each of the main risks currently faced by Lacera. And while it's not scientific, it does represent our opinion of the relative level of risk and how these individual risks stack up to each other. This is a very consistent chart with last year and prior years, but we have made some changes to the sort of the relative level of some of these risks, specifically the retiree COLA risk and the compensation risk. We have moved those to the right. And so that does mean that we believe there's a higher risk associated with both of those this year, and we're going to discuss that more in detail as we go forward here. Investment risk does still remain the highest risk facing Lacera and is going to be impacted by many of the factors that we just discussed on the last slide. Payroll risk. Payroll risk remains a fairly high risk also due to a lot of the labor market challenges that I've mentioned and that we've heard about this morning, primarily in hiring and retaining employees. And if there was to be any a lower payroll growth than expected in future due to, for example, either a shrinking or a non-growing workforce of Lacera membership, then that could have a negative impact on employer contribution rates going forward and cause them to increase. And so next slide, please.
So on this slide, we tried to kind of quantify those risks historically that Craig just talked about. As we go through this analysis, two key themes should be of no surprise to you. First, the future results will vary from current projected levels. And second, investment returns or the expectation of future returns are likely to cause the greatest variability in the future valuation results. And this can be seen on this graph. If you look on the right, this kind of summarizes all the changes in the unfunded liability since 2001. And remember, our actual term for that is the unfunded actual accrued liability. So that's benefits that have been accrued as of the valuation date. And so the unfunded amount is the shortfall between the current assets and the value of benefits accrued as of the valuation date. So this shows that there's been about $14 billion increase in the last 20 years in the unfunded amount. Primarily, you're going to see that in the assumptions and benefits. The assumptions and methods, and that's primarily assumption changes. And that's really driven by, over the last 20 years, the assumption for the investment return assumption for future investment returns has declined from 8% to 7%. And as all of you who have been around for a number of years know, just a 0.25% change in the investment return assumption has a material impact in increasing liabilities and costs. And as you can see, that 1% is the primary driver of that $8 billion increase. The one secondary one is there has been an increase in the expectations of life, how long people are living and receiving benefits. So that's also included in there. And the next piece is the investment returns, which have fallen short of our assumption. Remember, we started at 8%. And that's cost about a $5 billion increase, and that's cumulative. Lastly, there's a red block there for changes in benefits. That reflects the changes due to the MOUs back in about 2001. And those MOUs change past benefits, unlike obviously there's been some recent changes in benefits with PEPRA, but that only affected future benefits. So that's what the increase there is. Lastly, the other experience you can barely see there because overall, although we've had some ups and downs, as shown on the graph on the left, the overall impact of other experience, which is primarily salary increases and mortality experience, has kind of netted out. Looking at the graph on the right, the main thing I just want to point out here is the blue bars tend to be in most years, outside of a couple of years where there was some significant assumption changes. The blue bars reflecting the investment return has had the biggest impact. And remember, when we do the calculations of investment return, we're smoothing any individual year return over 5 years. So even with that smoothing, we still see that investment return is generally the biggest impact from year to year. Moving to the next slide.
Hey, Nick, I have a quick question. If we could go back one slide. So just to be clear, we set the contribution rates to address, to become 100% funded. We set the contribution rates essentially to have no or zero UAAL. And what you just described are all the different things that happen over time that cause us to increase the UAAL. Is that correct?
Yeah, so every year we retarget the contribution rate to effectively pay off the unfunded over the 20-year period. So that's exactly right.
Okay, thank you.
Okay, moving forward. So as retirement systems mature, they're more sensitive to risk, particularly investment risk. This slide shows the ratio of active members to retirees. The number of active members participating in LACERA has remained fairly level over the last 20 years. But on the other hand, the retiree population has been steadily growing since the actives are dividing by a bigger number, being the retirees. We see this ratio declining. So shown in the graph, the number of actives was approximately twice the number of retirees 20 years ago. And this has decreased to about 1.5 times today. And the retiree population is projected to be approximately equal to the active population in about 20 years. And we've actually seen some retirement systems in the country which have already hit this threshold where the active and retired population are the same. So this declining to active retired population is typical of a maturing system, but it doesn't directly cause an increase in the system's risk. Really, where we see that as far as the risk to the employer contribution rate is on the right. It shows the ratio of assets to payroll, referred to as the asset volatility ratio. This provides a direct measure of how sensitive employer contribution rate will be to future investment returns. The greater the asset volatility ratio, the greater impact future returns will have on the employer contribution rate. So as you can see in the example there on the bottom, for each 1%, the actual return is less than the assumed return. It causes a 0.56% of pay increase in employer contribution rate. So if you take an example, if LACERA had a negative 3% return, that would be 10% less than its expected 7% return. That would result in a 5.6% of pay increase in the employer contribution rate. Now remember, obviously we smooth assets over 5 years. So instead of having a 5% plus increase in 1 year, you'd have 1% increments in each of the over 5-year period. And also you'd also have a chance for a market recovery to mitigate that. In our evaluation last year, we saw the flip side of this, which is reflecting the return for the prior fiscal year, which was well in excess of the 7% assumption. We projected that this would cause the employer rate to decrease by about 7% of pay over the next 5 years. And of course, once again, this is based on all assumptions being met. But obviously, the flip side is good returns should drive down your future costs. Moving to the next slide. Another way to look at it is to kind of look in the rearview mirror at how the funded ratio and employer contribution rates have varied in the past. Although the past results are no guarantee of future results, it does give some additional perspective. The graph on the left shows LACERA's funded ratio over the last 25 years. Past investment performance and decreases in future expectations of returns have been the prior causes of the decreases in the funded ratio, from about 100% in 2000 to the current funded ratio just under 80%. And I'm sure most of you know, but just as a reminder, the funded ratio is the value of the assets divided by the value of the accrued liabilities. So where LACERA is at close to 80%, that means we have 80% of our assets relative to what our target of liabilities are that Ted talked about. So we've got about 20% shortfall. And how do we pay that? We pay that by moving, by calibrating our employer contribution rate each year. And you can see how that the funded ratio, sort of the inverse happens over on the employer contribution rate. When the funded ratio goes down, the employer contribution rate goes up. And we can really see kind of the variability there in that graph on the right, the employer contribution rate, as the rate has more than doubled in the past 20 years. Like the funded ratio, the primary driver has been of the increase in the employer contribution rate has been past investment returns, less than assumed, and reductions in future expectations. The change is more pronounced in the funded ratio due to the leverage nature of the employer rate calculation. So moving to the next slide, the prior slides looked at the underlying causes of risk and how they have impacted Lacera in the past. We'll now look at how this could potentially affect Lacera in the future, and I'll turn it back over to Craig to discuss how we assess future risk.
Okay, so when we're assessing these individual risks, we use a combination of scenario sensitivity and stress tests, as well as stochastic modeling. And we use these depending on the risk that we're assessing, the one that we think it might be appropriate for that assessment. The definitions included on this slide are taken from the ASOP 51 report, and I won't read them all, but I will discuss them a bit more as we move through the following slides. I will say that separate from this report, in the annual valuation report that we prepare, we do include a sensitivity test on the investment return assumption, where we look at what impact a change of 0.5% on the investment return assumption would have on the employer contribution rate and on the funded ratio. And in the GASB 67 and 68 report, that also includes sensitivity testing on the total pension liability and the net pension liability if the discount rate was to increase or decrease by 1%. And in GASB, the discount rate is, they use that for discounting liabilities. So that's the same as what we do use the investment return for on the funding side. And the sensitivity measure from GASB 67 and 68 also is included in the annual comprehensive financial report. So next slide, please. So the investment risk, as I mentioned earlier, we believe it's by far the largest risk. So it's the one that I'll spend a bit of time on here. To assess this risk, we're going to use a combination of stress testing, sensitivity testing, stress testing, scenario testing, and stochastic modeling. So the chart on the left here, which is using a stress test approach, and what it's showing you is the impact that a negative 10% return in a single year can have on the projected contribution rate. And for this purpose, we show the impact that could have if the negative 10% return happened in the first year of the projection, or if it happened 10 years later. So in this case, 2021 or 2031. So the orange line here, at least for the first 10 years or so, is the same line that we showed when we presented the 2021 actual valuation results, where the contribution rate is projected to decrease over time. But then what we're showing here is that in 2031, we're going to have a negative 10% return, and there's going to be a significant increase in the contribution rate as that negative return has to be amortized in the unfunded liability portion of the contribution rate. Comparing that to the blue line, which shows the impact if we had a negative 10% return in the very first year of the projection, we'd see a higher contribution rate immediately for those 10 years. But once we get out, to 2031 and or beyond 2035-ish, once the actuarial asset method has smoothed in the investment gains and losses, the maximum rate will be lower. Employer contribution rate will be lower than it would be with the later investment shock. And the 2021 investment shock also would result in a higher funded ratio at the end of this 20-year period. It would be about 100% compared to 91% under the 2031 investment shock scenario. And one other comment on this one is that under the 2021 investment shock here, we project here that over the next 30 years, total contributions, employer contributions would be approximately $90 billion, whereas under the 2031 shock, it would be about $101 billion over that 30 years. So the later shock will result in higher contributions over that 30-year period. So the chart on the right is a scenario test, and this is where we model the impact on the employer contribution rate and the funded ratio if the next 10 years of investment return looked like they did in either the 1990s or the 2000s and the 2010s. And those were the investment return in those decades was quite different. So the orange line here shows the projected contribution rate if we had a repeat of the 2000s scenario for the next 10 years. And after the 10 years, we assume we go back to the 7% annual return after that. So, but if we had, if the 2000, sorry, repeated themselves immediately over the next 10 years, the orange line is what the projected contribution rate would look like. And that increase is obviously largely driven by the 2008 and 2009 financial crisis and the decrease in the investment markets then. The blue line here shows if we had a repeat of the 2010s. So that's a much better picture because we've had much better returns over the last 10 years or so than we did in the 2000s. And the green line shows a repeat of the 1990s, which is the best of these three scenarios here. Now, I will note that the 1990s scenario may be unlikely to be repeated in the next 10 years because during the 1990s, there was large declines in interest rates that helped to drive strong investment returns. And given the market and the economy as it is right now, it's perhaps unlikely that we'll see we're more likely to see interest rate increases than decreases over the next several years. So the market is over the next few years is likely to be quite different than it was in the 1990s. Next slide, please. So we also performed a stochastic analysis, and this is where we use Lacera's assumed 7% annual return and the 12.4% standard deviation of the target asset allocation. And we run 5,000 simulations of expected investment returns over the next 20 years. We then use those 5,000 simulations to create another 5,000 simulations of the employer contribution rate projections. So in this chart, the blue line shows that of those 5,000 simulations, this is the median outcome of all of those simulations on the employer contribution rate and funded ratio. So 50% of the time, the employer contribution rate would be expected to be above the blue line, and 50% of the time it would be expected to be below the blue line. The orange line is the 75th percentile, which at that level, we're saying that in 75% of the simulations, the contribution rate is expected to be below the orange line, and 25% of the simulations, it would be above the orange line. So that would reflect sort of a poor investment return, the poorer investment return scenarios. And over the period of this projection, the compounded return on that scenario is approximately 5.1%. The green line is the 25th percentile return. And so in this case, in 25% of the 5,000 simulations, the contribution rate would be expected to be below the green line, and in 75%, it would be above the green line. And in that case, the compounded annual return is about 8.8% is what's shown in that green line. So basically, we're seeing that in approximately half of the simulations, we would expect that over that 20-year period, the employer contribution rate will be between the green line and the orange line, and 25% of the time it would be above the orange line and 25% below the green line. So obviously there's a significant amount of variance in those rates, especially as we go out further in time. And the primary way that to reduce that variance would generally mean lowering the standard deviation of the portfolio so that there's less risk involved in the portfolio, but that would also likely cause the median line, this blue line, to increase. So you'd have a trade-off of lower risk, which would increase the median expected contribution rates over time. Next slide, please. Moving on to compensation and payroll risk. And to assess this one, we are using a scenario where we measure the impact if the long-term compensation and payroll growth was 1% higher than the annual assumption, and or if it was 1% lower. And we use the terms compensation and payroll here, and they do mean slightly different things. When we talk about compensation increases and compensation risk, in that case, we're typically referring to the annual increases that will be given to current employees, the current membership. And when we talk about payroll, we're looking at the total payroll of Lacera that would be used as the base to amortize the unfunded liability. So generally, we see that those move somewhat in line with each other. So if you're getting higher compensation increases for existing employees, in general, the payroll is growing. And the opposite happens as well. If there's lower compensation increases than assumed, the payroll isn't growing as fast either. And so you can see here that in a higher compensation and payroll environment, we are expecting higher employer contribution rates over time, and that's shown by the green line. But if the compensation and payroll was lower than assumed, we're expecting lower employer contribution rates over time, as shown by the orange line. Now, one thing that is a potential risk would be, and given some of the macro challenges that we're facing right now, is with high inflation, if compensation increases, those increases to current employees, if those were to be higher than we assume in the valuation, but at the same time, potentially there was either a static or a shrinking payroll due to some of the challenges of hiring and retaining employees, you could end up with a situation where you have high compensation increases with a lower payroll growth, so a bit more of a disconnection there than we typically see. And that would be, as far as the impact on the employer contribution rate, that would be sort of the worst of both of those scenarios, because they would both have a negative impact on the employer contribution rate and cause it to increase over time. Next slide, please. So I mentioned earlier that the high inflation environment that we're in can cause an increase in the level of risk related to the retiree COLAs. And so this is going to be seen in two ways. And the first is in the regular COLA increases that retirees receive. Now, those are linked to CPI each year. And depending on the plan that the retirees are in, it will be capped to either 2% or 3% annually. And Lacera has COLA banks, so that in years when inflation is higher than that cap, the excess amount will accumulate in the bank, and then that can be used in future years to top up retiree COLAs if CPI is lower than that maximum 2% or 3%. So in the valuation, we do include an assumption for the rate of those annual COLA increases. And since we have a CPI assumption of 2.75, we're generally assuming that retiree COLAs will be linked to, since they're linked to CPI, that they will be 2.75% subject to those caps. So this means that in the plans that already have a cap at 2%, we're already assuming that the maximum, that 2%, will just be paid every year. And so the high inflation doesn't have very much of an impact on that group of the retirees. But there is a group of retirees that have a 3% cap. And so since we're assuming a 2.5% annual increase, but those retirees are likely to get a 3% increase for several years, we are going to have a small actuarial loss, because those benefits are going to be increasing slightly faster than assumed at 3% compared to 2.75%. But that is a subset of the retiree population, and it's only the 0.25% each year. And so the impact overall due to this part of it is going to be fairly limited. Next slide, please. So the second way the inflation can impact the retiree COLAs is through the STAR COLA. And the STAR COLA can be provided to to retirees when their benefit has lost more than 20% of its original purchasing power since their original retirement. And so over the last 10 years or so, we've been in a relatively low inflationary environment. Inflation's generally been below those 2% and 3% caps. And so STAR COLAs have not been awarded to any retirees for over 10 years because no retiree allowance had lost at least 20% of its purchasing power. However, this year there are retirees who are going to cross that threshold. And so STAR COLAs may be provided to those retirees at the discretion of the Board of Retirement. Those could be given on an ad hoc or a permanent basis. And the difference on that is just on the ad hoc basis, the Board of Retirement could elect to award the STAR COLA to bring the retirees back up to 80% of their original purchasing power. And they could do it just for a 1-year time and then say that, well, next year we'll revisit this and decide if we want to do it again next year. Or they could go ahead and make it a permanent increase where they would just increase the benefit of the retirees to that 80% level, and it would be permanent going forward without any future decisions having to be made on it. So there is a STAR reserve that's currently available. It's $614 million, and that's available to offset any of these STAR increases. But so that there is funding there for these. However, any reduction in that reserve is going to have a negative impact on the employer contribution rate and the funded ratio, because the $614 million is currently included in the assets, but there are no STAR liabilities currently included in the funding valuation. So if the STAR reserve if STAR COLAs are given, the liabilities are going to increase and the STAR reserve is going to decrease. And so that's going to have a negative impact on funded ratio and employer contribution rates. And we estimate the increase, if the STAR reserve was completely depleted, would be about 0.5% of payroll on the employer contribution rate and a decrease of about 0.8% on the funded ratio. Next slide, please. So when we look at mortality and we look at assessing mortality, actuaries can generally project mortality fairly well. So overall, the mortality risk should be quite small. However, due to the pandemic, we did see an increase of approximately 20% in the number of retiree deaths in the year ended in 2021 compared to the years in 2019 and 2020. And so if this pattern was to continue, or if the number of deaths also going forward was to be significantly lower than we were assuming by the assumptions, this could also have an impact on the employer contribution rate. And so what we're showing in the chart here is the blue line, again, is the baseline, and that is using the assumption for the rates of mortality that are included in the valuation and projecting out the employer contribution rates at that level. The orange line shows the increase if the rates of mortality were to decrease, and the green line shows the effect if the rates of mortality were to increase, in each case by approximately 17% per year. And so that's roughly the change between 2020 and 2021. And so you can see on the orange line, if fewer people were to die over time than we were assuming by that 17%, the employer contribution rate is going to increase over time. And the opposite happens if more people were to die at that rate of approximately 17% more per year every year. So we think that's a fairly extreme example. I mean, certainly we would hope that maybe the number of retiree deaths will decrease over the next few years from that 2021 level, as the major impacts of the pandemic on mortality hopefully subside. But that with some fairly extreme mortality examples, the impact on the employer contribution rate is going to be approximately that 10% by the time we get out about 20 years. Next slide, please. So the last risk that we'll discuss here for assessment is contribution risk. And so the primary aspect of contribution risk is if an employer was not making their required contributions. And across the country, for some retirement systems, this has been a bit of an issue. Because the employers and the plan sponsors have not been paying their actually determined contribution, and they've gotten themselves into a bit of financial distress. Now, we're not necessarily qualified to assess specifically the counties and other employers' ability to make their required contribution, but they're certainly the history and the pattern of LACERA and from their employers, the county and the employers, has been to consistently make the actually determined contribution. And there are legal requirements in the 37 Act that govern those future contributions. So we have no reason to believe this is a significant risk. But however, there is a risk there that if the county or the employers don't make their full contributions in the future, it could present a significant risk on LACERA's funding. A smaller risk there, and this is one that does happen, is the concept of pushing contributions into the future. And this happens primarily when assumption changes are made, and the impact of that assumption change is phased in over 3 years rather than recognized immediately. And so in effect, what we're doing is we're deferring the contributions by those 1 and 2 years. And so that does have a negative impact on the funding in those first couple of years and causes a higher contribution rate down the line. But that's we don't think it's a significant risk, but anything that happens that does defer the receipt of those contributions does and push the contributions into the future does cause a minor risk to the funding of LACERA. And I will hand with the next slide, please. I will hand it back to Nick to talk about how we address some of these risks.
Yeah, hopefully what you took from Craig's presentation of the assessment of risk is, once again, that investment risk is that's definitely the one we're most concerned about and need to monitor the closest. So the purpose of the risk assessment report is to understand the risk to LACERA's funding, which hopefully we've communicated to you. So the next logical question is, what can LACERA do to mitigate these risks? Well, we believe LACERA is already addressing funding risks in the key areas. The board has policies and procedures to guide it in the fulfillment of its fiduciary responsibilities and to address the management risk. Specifically, we call out on the asset side, LACERA regularly performs asset allocation studies, which not only attempt to optimize return, but consider the impact of the variance in future returns on LACERA's funding. As a result of the study last year, LACERA modified its asset allocation. To provide the best estimate of liabilities, LACERA reviews its assumptions in detail every 3 years. The next assumption review is scheduled for this fall, as we talked about. Lastly, LACERA updated its funding policy a couple of years ago to reduce the amortization period to pay off the unfunded liability, which reduces the risk of LACERA having a low funded ratio in the future. So can LACERA further reduce its risk? Well, the answer is yes, but as Craig talked about, when you reduce risk, there's almost always a trade-off. For example, LACERA could move to a more conservative investment allocation, but that would either increase the likelihood of not meeting that assumption or result in a lower return assumption in the future, which would either way would push out increases in the contribution rate. So moving to the next slide. So as a mature plan, LACERA is subject to a number of risks, which could ultimately affect funding ratio, employer contribution rate. As I talked about, and Craig really showed you, investment returns have historically had the greatest impact, and it's likely to continue. As we just talked about in the last slide, Lacera has several mechanisms to address these risks, but obviously they can only mitigate risks. I mean, the risks are always going to be there, and reducing risk creates a trade-off. So we're not recommending any action at this time, just that little Lacera continue to monitor the risks and consider them in context of the assumption review this fall. So that concludes our presentation.
Thank you very much for your outstanding presentation. Any questions? Comments? Hearing none, we're moving forward. The next item is we continue with reports. Ms. Raslan, legal transactions.
Okay, can you hear me?
Yes.
Great. I'll try to keep it short. I know you've had a long morning. So the legal report in your board package reflects the work of the transactions team in the legal division in 2021 in terms of number of contracts and the value of those contracts in dollars. The team is responsible for handling all investment and other Lacera commercial transactions, as well as Public Records Act responses. Most of the report is a series of charts for different asset classes, divisions, and public records requests. Those charts reflect a few trends that I'd like to highlight today. First, we saw an increase in overall volume of work for both investments and commercial transactions, demonstrating that the investment office, the transaction team, and Lacera in general were busy last year negotiating new deals, signing up new vendors, and managing existing relationships. The increase in the volume of work for our team relating to investments is attributable to more complex transactions, as well as increased activity in private equity, credit and hedge funds, and the real asset space. Specifically, private equity saw an uptick in co-investment transactions. The credit and hedge fund team was busy building out a DMA platform and onboarding several new managers, while the real assets team was focused on due diligencing and onboarding new managers to meet their allocation targets. All this activity kept the transactions team fully engaged throughout the year. For commercial transactions, both the volume of work and value of contracts increased since last year. Most of this increase in activity is attributable to new IT agreements, which resulted from Lacera's focus on modernization and a shifting emphasis from on-site capabilities to a remote and hybrid workspace, as well as bolstering information security. Finally, public records requests have experienced a slight reduction year over year, which we believe is due to us posting more information on the newly revamped Lacera website. I would just note that we may have difficulty sustaining this level of activity at our current staffing levels this year since we've experienced some attrition, but we have recruitment underway, so hopefully that will change. As a final comment, I'd like to thank team members for all their hard work throughout the year. We're a small team with a busy desk, so I'm very grateful for their contribution to these numbers. With that, I'd like to open it up to any questions you may have for me.
Great, thank you, Ms. Rasland. I don't see any requests for comments or questions. Again, thank you very much for your presentation. The other reports are all for information C, D, E, F, and G. Any questions or comments regarding any of those reports? I don't see any. We move forward. Then items for staff review, Linda?
I don't have anything.
Thank you, ma'am. Go to the order. Linda, would you do roll call, please?
Absolutely. Mr. Green?
I don't have anything except thank you, Mr. Chair, and thank you to the staff. Appreciate it.
Thank you. Mr. Kehoe? Okay. Mr. Jones?
Yeah, likewise, thank you to the staff, both the real estate group, Jim, and the real estate team from this morning, and Santos and Jonathan obviously do a great job on their end, but the supporting information. So there's a lot to get through, but Appreciated it. And then thanks to Millman as well for the accurate actuarial report as well. That was very, very insightful my first time through. So thanks.
Thank you. Mrs. Jones?
Thank you for staff and the reports that we received. Thank you, Mr. Grable, for answering some of my questions ahead of time, so I didn't have to ask them. And they were very thorough answers. I too, like Trustee Jones, appreciate the actuarial information. And I do look forward to looking at that as time evolves. We obviously are having a large number of retirements as per the Chief Executive Officer's report. And I'm just curious to see, as the number of retirements increase and the number of new employees into the government system, they find they want to do other things. They don't want to work for government. So I'm curious to see how that's going to evolve and affect our actuaries as we move out, 10 to 20 years from now. I think the era of people working in employment and government for 20 years plus is shifting. And so I don't know that we'll have that same makeup as we move forward. So I am intrigued by that. And I do look forward to the offsite meetings that we're going to have in September. So I'm going to mark my calendar so I can participate. Thank you.
Thank you, Ms. Jones. Mr. Grable?
Thank you, Linda. Just want to thank Christine Roseland for the update on the legal transactions. And I think it's a great example of how everyone on LaSera staff is not partially, but wholly dependent upon others in order for us to do our job. So thank you to the legal office.
Thank you. Mr. Kryman?
Nothing from me, thanks.
Thank you. Mr. Rice?
Nothing, thanks.
Anyone from the Makita team?
Nothing at this time. Thank you very much.
Thank you. And lastly, Chair Santos.
Yes, thank you. I also want to echo Mr. Grable's compliment to Ms. Roslin. Many times we don't realize the key work that the attorneys play in negotiating those different contracts. So really appreciate the work that is done there. And I agree with Mr. Grable. It's all a team effort. We all mash together to continue the performance of this great fund. So thank you very much. Thank you to staff. And with that, I will entertain a motion to adjourn.
Motion to adjourn.
So move. Thank you.
Thank you.